Hi, everyone. You are now through that portion of the course which deals with the more mechanical aspects of financial accounting, the process by which we prepare financial statements. And it's time for us to begin to focus now not on the mechanical aspects of what is recorded and what is shown on which financial statement. Now we need to talk about how we measure things and what the traditional problems are that we run into when we're in these various measurement processes. We're going to start with the income statement. We'll deal with revenue recognition primarily, but also expense recognition to a certain extent. Now, part of our problem measuring revenue is that it's a whir of continuous activity. That is to say, we start by taking an order from a client. Perhaps we begin manufacturing. We complete manufacture. We ship. We bill. And the warranty. Oh, hopefully we get paid. And then the warranty runs out. If you've got 3 of these going on, or if you've got 3 million of these going on at the same time, we face the same problem. And that problem is that we've got to decide where in this listing of activities we will say revenue has been earned. Because you remember, the revenue recognition principle told us that we recognize revenue when it's earned, realized, or realizable, translation collectible, and measurable. So we've got to find some place in this process, and it creates no shortage of difficulties for management in their measurement, because the financial statements, after all, belong to management of a company, or the auditor, who has to step in and decide if management has found the right place. So revenue recognition is complicated by the fact that you've got all this activity going on at the same time. And we need good cutoff. We need to say that some point in this set of activities, there is a magic point at which we may say we have earned revenue. Now, we're going to have to produce these periodic financial statements. And that means that we need on December 31st to be able to say revenues that were earned at that point belong in the year before. Revenues that are earned after that point and meet the criteria for recognition, realized, realizable, and measurable, go into the next accounting period. So our need to artificially divide the life of a business into these discrete periods creates this measurement challenge for us. We get further measurement challenges handed us as a result of the dot-com era and problems that were associated with the dot-com era. You may remember that this is late 90s and very early 2000s. We ran into some interesting issues. Suddenly, the bottom line to the income statement may not be the most important number on the income statement, because we knew that companies that were new, that were startups really, in the internet business, were selling their shares at remarkable prices. What the market was looking for in that era was the market was very interested in seeing top-line revenue growth and marketing expenses, because top-line revenue growth they took to be an indication, the fact that this was a business that was securing its market share in this new internet vehicle. And they expected that the fight to secure that would require some pretty significant marketing expenses. And so instead of looking at businesses that had not made money and that probably wouldn't make money in the next 2 or 3 or 4 years, indeed may outrun their capital before then, the market gave a good deal of credit to those companies. And their shares sold for handsome multiples in many cases. So under the circumstances, we suddenly found ourselves worrying about things that we'd not worried about before, because management wasn't foolish. If top-line growth was what the stock market wanted, then let's arrange our affairs so as to give us top-line growth. And so we began to see companies that would not normally have reported their top lines, that sales number, in a particular fashion, changing the way they reported their numbers. Priceline, for example. Priceline will arrange for you an airline ticket. And when you make your reservation, and that reservation is accepted by Priceline, they immediately go out and buy the ticket and sell it to you. They are, in point of fact, the owner of an airline ticket for only a few minutes in time. Indeed, maybe only seconds in time. But instead of reporting income the way agents traditionally report income, reporting the commission that they receive as revenue, Priceline reported 100% of the price of the ticket as revenue, and then a cost of goods sold equal to, in the case of airline tickets, pretty consistent 96%. So we discovered that that method that Priceline was using was not acceptable, and their revenue, because they didn't own the inventory long enough for them to really be and appear to be at any risk of loss in ownership, their income is really the same income they would have earned as an agent, only 4%. We had similar problems with marketing expenses. People wanted to pour all sorts of things into marketing expenses. And we discovered that that was a problem as well. Okay, now the theory of revenue recognition begins its critical interest here in this conflict between relevancy and accuracy. Do we want relevant information in our financial statements or accuracy? Now, the truth of the matter is that we'd like to have both. What would relevancy imply? Relevancy would imply that the information was timely. Discovering that 3 years ago, a company did something, and the consequence of which is that the warranty is now passed, and we know exactly how much they have earned in this process. Doesn't do us very much good trying to make timely financial decisions about investments or lending to the company or any of the other needs of any of the other financial statement users. Relevancy implies that the information that we present in financial statements is many things, but among them is timely. And so what we have decided is that although it seems unusual that we will disregard our concern for penny-to-the-penny accuracy, the fact is that relevancy is really very important, very important. And so we tend to recognize revenue before the warranty has expired. Indeed, we tend to recognize revenue long before we have been paid. What we tend to do is we tend to recognize revenue when it's earned, realized or realizable, meaning we have a reasonable expectation of collection, and when it's measurable. All right, so our challenge became looking at that stream of activities. What's the critical event? That thing which triggers recognition, the event that establishes the first point in time where revenue meets all of our conditions. With respect to the first of the requirements, earned, we've decided that the word earned means substantially everything has been done to indicate that the earnings process has completed itself. Often, it's at that point in time where revenue can be legally claimed. Now, in most instances, probably well more than 97% of all circumstances, we will recognize revenue in the United States when title changes hands, because that's the point when we're certain we have a sales transaction. That's the point when we know exactly how much we're owed, and that's the point in time where we understand the transactional elements and they're all in place. That's the first point. Now, if we go back and look at this ordering, Deloitte did a study of 31 companies in the Silicon Valley who were not currently audited by major accounting firms, and they discovered 2 firms that recognized revenue when they received an order, even though they hadn't produced anything yet. And they found 1 firm that recognized revenue only when the warranty expired. So it's clear there's a great deal of variability when the auditor is not involved. Our challenge is that with an auditor involved and understanding generally accepted accounting principles, we are going to typically recognize revenue at the point the title changes hands. Now, that's not necessarily an easy number to develop. That could be complicated. If I send goods to a customer and I pay the shipping, that is, I pick the common carrier that's going to carry the goods and off they go. Interestingly enough, the title, unless our agreement specifies otherwise, common legal rules would say the title changes hands when they are received on the other end and accepted by the customer. On the other hand, if the customer chooses the common carrier and contracts for the transaction, then under the circumstances, just putting them on the common carrier is the point in time where we have a transaction and a change of title. So there are still complications here, even using that simple set of rules. We've got problems with advanced payments, and we've got problems with multiple processes. You have to be cautious when you think about transactions. For example, you don't want to recognize revenue when you're building a car when you add additional components to the car. You might view this as a multiple earnings processed setup, but it's the transfer of title on the back end that's critical, not meeting certain stages in the manufacturing process. And remember our problem with advanced payments. Advanced payments aren't typically earned. They secure a transaction and start a process that ultimately, if things go well, end up being earned. And so advanced payments are not revenue. They have to be performed upon before we may be said to have revenue. The second requirement is that revenue must be realized or realizable. To be recognized, there must be a reasonable expectation of collection. Got to have a reasonable expectation of collection. If not, then under the standard U.S. rules, we might decide you don't have revenue at all. Under a new set of revenue recognition changes, we might conclude that you get to recognize only a portion of the revenue. All right? And measurability. Revenue has to be subject to be reasonably estimated to be recognized. Now, this doesn't generally cause problems for us. Most instances, our contracts lay it out pretty clearly. But if there are contingent elements in the contracts, for example, you're leasing land to an oil company, and the oil company gives you a royalty interest, then what you have just received in this transaction is a share of the oil they bring out of the ground. Well, when that happens, and only as they bring it out of the ground, do we recognize revenue. We're not going to be recognizing revenue beforehand, because to do so would require an unreasonable measurement and would require that we were unable to be certain that that revenue would be earned or accrued. Okay, now, peculiar adjustment, or a peculiar thing to consider, we've got to also be able to reasonably estimate costs and expenses. Got to be able to reasonably estimate costs and expenses. Because if some of our costs or expenses, some material costs and expenses are in fact also subject to uncertainty, material uncertainty, contingencies, for example, then we might violate the matching principle if we jumped ahead and recognized the revenue but didn't know how to appropriately estimate the costs that would be associated with them. So measurability implies both that revenue is subject to reasonable measurement, reasonable estimation, and that all related costs and expenses are as well. Now, in the United States, over time, what's happened is that we have run into a large number of revenue circumstances that create problems for us. And these revenue circumstances are situations where we have sent the wrong message as a result of relying only on these three principles. And so our tendency has been to adopt special rules and procedures that we will be involved with. For example, commodities. Gold. At what point in that earnings scheme do you recognize revenue from gold? The answer is sooner than you might have anticipated. Because gold is a commodity, it's produced to a uniform standard so that it may be traded on a commodities exchange. And that uniform standard and that exchange tell us that there is a ready market to buy and a ready market price rather easily measured at any point in time. And so when you analyze gold mining and smelting and turning it into this ingot of gold that's a standard unit, we recognize that the only thing left to do after we've manufactured, after we've produced the ingot, is to pick a phone up and place an order. And that, we believe, is too little. And so normally we recognize revenue in the mining of commodities that have those characteristics. We'll recognize them at the time they are ready to be sold. We won't require that last telephone call. Franchises have posed lots of problems for us. Back in its heyday, franchising was the way to go. And a lot of businesses were organized around a franchise model. The franchisor would make available all sorts of technical data about what a retail outlet might look like, must look like, where they buy their signage, where they buy the materials, the goods that are going to be sold, how they prepare those materials or whatever involved in the sales process. And we gave some training. So a lot of advertising went into selling franchises initially, and people flooded in. Everyone wanted to be their own business owner. And so we would see the franchisor's revenue skyrocket, even though they may be only collecting 3% or 5% of the ultimate franchise fee that had to be paid. And then we would wait, because invariably not everybody who paid that 3% or 5% really knew how to run a business, could really put the capital together to build the building and do the other things that were required. So the Financial Accounting Standards Board decided that franchisors could recognize revenues only when they had received 15 or 20%, I think, of the original franchise fee. They would keep it as unearned revenue until they had collected enough to lead everyone to believe that the transaction was going to go through. Similar problem with retail land sales, buybacks, insurance. In the insurance case, recognizing revenue from a measurability standpoint wasn't our problem. Our problem was estimating the amount that we would have to pay out in the following year to meet the insurance claims. So we've got all these special situations and complications. And what we've done in the United States is that we've tended to use a wide variety of special rules, guidance on how this should be done in this industry and how this should be done in another industry. IFRS has chosen another path. All right. Revenue recognition, before we managed to get together and talk about it under International Financial Reporting Standards, was based on a single, very general standard that was perceived to be pretty broadly applicable, much less specific guidance. IFRS in general does not believe that this kind of guidance should be given from a standard setter. They want management and their auditors to tussle over the special issues and the special problems, and they want this general standard to be the guidance. In 2010, and I've included these data because I want you to see what can be involved. In 2010, a revenue recognition proposal was published, and it was published jointly by the Financial Accounting Standards Board and the International Accounting Standards Board. And again, the core principle that revenue is recognized when it's earned through the transfer of goods or services to a customer. And in general, we've taken that to mean transfer of title. And it is recognized in the amount expected to be received from the customer. Now, the standard was finally adopted in 2015, so it took 5 years from proposal to standard, and it is not a fully converged standard. There are still some differences between IFRS and GAAP in this standard. And furthermore, it'll probably be 2018 before this is fully effective for all companies that must report their earnings to the Securities and Exchange Commission. So this has been a long time coming. We're going to see that under IFRS, if you've got a single contract with multiple revenue streams, then the new standard, both GAAP and IFRS, require that we break this contract down into parts and value them separately. And as an issue, we're going to see the collectibility is primarily affected the amount to be recognized, not the timing of recognition. Historically, our answer to a lot of uncertainty about collectibility in the United States was to say, don't recognize it, or recognize it only as payments are received. It's not great accounting. You get terrible match, all kinds of problems with it. But if the uncertainty was that high, we opted to be very conservative. What the new standard tells us is that it's not the timing that's primarily going to govern this. It's going to be the amount. And so what we would do would be agree between the client, the auditor, and the Securities Exchange Commission what part of a material uncertain amount could be recognized in year one, and defer the recognition of any more until later periods, rather than strictly focusing on the timing of recognition. Again, IFRS doesn't believe in this piecemeal approach for special rules. IFRS is not at all pleased with that. The new approach that we've adopted in this nearly converged standard tells us that we will likely recognize revenues without the benefit of this kind of guidance from the standard setter. But it remains to be seen if indeed that's the way it really works. Ultimately, the United States, with a not completely converged standard to start with, could choose to go ahead and reinstate a good bit of that specific guidance that it had been giving in the past. All right, revenue recognition. All the problems that auditors, clients and the SEC have, revenue recognition is the greatest. There were more mandated financial statement restatements by the Securities Exchange Commission involving revenue issues than all other issues combined. It's a challenge for the auditor, it's a challenge for the company, and the SEC assumes that the company will try and recognize more and more revenues sooner and sooner if they can. And so they expect the auditor to make sure that the line is towed, and they still find circumstances in which they disagree with the auditor and the company that they're regulating. So a lot of attention here. It's like 5 pages in your textbook. Not much there. A lot of attention, though, in the real world here. All right, that's revenue recognition. I look forward to hearing from you.